right, welcome back to the exchange. We've got the trade on three big gainers of the past year. They are homebuilder Toll Brothers, cybersecurity company Palo Alto, and Wingstop. They sell wings ahead of their results. Our trader today is Lee Munson, Portfolio Wealth Advisors President and CIO. All right, Lee, you ready? Let's kick it off with Toll Brothers. Toll Brothers stock soaring up nearly 40% since October. Mortgage rates easing off their highs. Wells Fargo watching order volumes and builder sentiment as lower rates reduce the need for buyer incentives, although rates have stabilized, if not ticked a little higher in the last couple of weeks. Lee, how would you play, if at all, Toll Brothers?
I like Toll Brothers. I don't think it's about the rates. I think it's about if they're going to actually complete 10,000 homes this year. Remember, they're looking at 10,000 homes this year at almost $1 million average price. Here's what they're doing and why I think it's less of a rates issue. They're trying to build what they call affordable luxury, which just means taking a big house, putting it on a cheaper lot with less upgrades. That's making it affordable even as rates stay high or sticky all year. I also think that their general strategy of trying to make more affordable homes, it's a big thing for Toll Brothers. They're always into the high-end luxury stuff. I think this is the right way. I don't see anything problem with the stock. If you own it, I'd hold it.
Own it, hold it. There you go. All right, Lee, next up is Palo Alto Networks. Shares more than doubling over the past year, gaining 25% already in this year alone. Goldman Sachs noting secular drivers and cybersecurity, including an elevated breach backdrop, whatever that means, thanks in part to the Israel-Hamas war and the upcoming election, as well as easing spending headwinds. Would you trade? Would you own? Would you sell? Would you hold Palo Alto?
For full disclosure, I own it, and I love it this year. I think it might have gotten a little ahead of itself. I don't care. Here's what the issue is. It's can they execute? Now, you are going to hear some news about how they keep talking about the price of money. A lot of their clients are these Silicon Valley startups and what have you that, are living off of private equity lines of credit, right? And so I think that if you get in a quarterly results where they say, well, we're having problems where people want to lengthen their duration as if they're bond traders on paying for these softwares, I think that might be an opportunity if it pulls back. But here's where the big opportunity is. A third of Palo Alto's workers themselves are independent contractors with unmanaged computer devices. So much of us in big business have unmanaged devices. That's where the opportunity is. I think there's got a lot of tailwind to this. I would just hold it. I think this is a multi-year play.
Hold it. Multi-year play. All right. By the way, folks, do not miss Cramer's exclusive interview with the Palo Alto CEO following those results. Mad Money tonight. So Jim's got the CEO of Palo Alto and the CEO of Walmart. Another big night on Mad Money. All right, Lee, finally, listen, you're a vegan, from what I understand. I don't know how you live, but you're a vegan. And so I doubt you've had their product. But Wingstop, maybe you're eating the stock because shares are up 90% in the past 6 months. Stifel, they expect to see positive sales growth. Wingstop launching new offering. Input costs stay low. You may not like the product, Lee, but what about the stock and the company?
I asked my young analyst who definitely eats hot wings, and he was like, it's much better than Buffalo Wild Wings. They have a less crappy option for that market. Now, here's what I love about it. It's kind of like one of those classic Peter Lynch where it's like, is the story getting better? And then number two, do they have runway? They have a little bit more stores than a Five Guys, about half as much as Chipotle. I don't think this is going to be the new Kentucky Fried Chicken or some big chain, but they've got another 2 or 3 years of packing on 250, 300 stores before they start saturating America. Remember, it's a cheap franchise to own. They can get you in there for $400,000 to $600,000, but you got to buy 3 of them. So, think about that. So I think this company, I'm most excited about it. I don't own it, but I'm definitely looking.
There you go. And you got the sideways taste test. Lee Munson, Portfolio Wealth Advisors. Lee, thank you very much. Folks, that's it for the exchange.